Hi everybody and welcome to CACEIS webinar series. The topic today will be securities lending in 2024, how the industry is adding value to end investors throughout a period of regulatory and market change. And today we have the collaboration of S&P Global Market Intelligence. What we're going to see today, just to go through the agenda, is first of all, thanks to Matt Chessum, who's a director at S&P Global Market Intelligence, review the industry performance so far from 2020 to 2024, the evolution of the revenues, but also who are the biggest lenders and what are the assets class which are more in demand. Then I will myself, so Donia Rouigueb, head of sales for the Securities Finance and Repo desk at CACEIS, I will share with you the current trends in the industry, what are the hot topics today, but what also are the topics that we will have to address going forward. On the third part of this webinar would be about CACEIS Market Solutions, presented by Remy Ferraretto, who's senior sales in our Securities Finance and Repo desk at CACEIS. And he will details how we are helping our clients to address their performance goals through a wide range of services. And last but not least, we will try to get some time for a Q&A session where you will be able to ask all your questions. So please feel free to send them right now or later. And of course, we will address the question that we will not be able to answer to later after this webinar if we don't have time. So now I pass the ball directly to you, Matt.
Thank you very much, Donia. So, my name is Matt Chessum and I'm here representing S&P Global Market Intelligence. At S&P, we offer numerous operational solutions to the securities finance market, including an independent proprietary database that provides daily transparency into the securities lending markets. So the main source of our data comes from prime brokers, custodians, asset managers and hedge funds. And the data is used by the market primarily to assist in the pricing of securities financing transactions, in helping to identify intraday liquidity risks, benchmarking portfolios, and in monitoring daily or periodic short squeeze risks as well. So looking at this first slide, the first thing that I would point out is that following 2 consecutive years of near record revenues, as can be seen by the graph on this slide, revenues during 2024 to the end of May have been lower than those that were seen over previous years. Now, contractions can really be seen across both America's equities, Asian equities, and in some of the corporate bonds that have been lent as well. Now, across the equity markets, the decline in revenues is really a result of fewer specials being lent. Now, specials, any equity that is traded above a fee of 500 basis points, we've seen fewer specials, we've seen less specials activity, I should say, during 2024 than we saw in 2023. Now, in 2023, in particular, there were a number of equities that helped push equity revenues substantially higher. One example of this would be the American cinema company AMC, which produced a near record $650 million alone. Now, this stock was widely held across a number of lenders, and this really did help to increase market revenues across the board. So during this year, really, whilst we are seeing a number of stocks that do continue to trade at elevated fees, the opportunity for lenders has probably not been as strong or as significant as it was back in 2023. Now, across the fixed income assets, average fees have remained above multi-year averages, but they have declined in comparison to, again, the fees that were seen during 2023. Now, the future path of interest rates, as soon as there was an interest rate pivot that was announced, that had an impact on the fees that were being demanded for fixed income assets in the securities lending market. Now, on-loan values for fixed income assets have been higher over the first 5 months of this year, but average fees have declined, which has reduced revenues overall. So to the end of May, market revenues, when compared to 2023, don't look as strong or as compelling as perhaps at this point in time last year, and remain approximately about 20% under what we were seeing during 2023. Despite this, $4.73 billion worth of market revenues have been generated. This makes this period from January to May of 2024 the fifth highest revenue producing year since 2006, when our data collection service started. So really, when we're looking at revenues for 2024, we do really need to keep it in a broader context of a longer time period. Now, as we head into the second half of the year, with markets continually hitting new all-time highs with no real significant period of correctional activity, interest rate divergence now being a reality, increased volatility being seen across Europe, and multiple elections still to take place across a number of global democracies, I do believe that it's possible that the second half of the year is going to see more market volatility than was seen during the first semester of 2024. Now, given that volatility is often positive for securities lending markets and for securities lending demand, I really do believe that revenues are likely to close the gap on those that were seen during 2023 in the coming months. So moving on to global average lendable by lender type, we can see that following record highs seen across global equity markets during the first half of the year, it's really going to come as no surprise that lendable across all market participants has increased when compared to last year. Now, lendable inventory increased across all participants, with asset managers now contributing over $21 trillion worth of lendable assets to the securities lending market. Now, the size of the lending market also reached its highest level since 2021 during the first period of 2024, hitting a massive $37.6 trillion worth of lendable inventory during March. So looking at on-loan balances decreased across asset managers, pension funds and insurance vehicles over the period. On-loan balances increased significantly across sovereign wealth funds as demand grew for both term and financing trades. On-loan balances declined as a result of a significant fall in demand across European equities in particular, and a bit of a slowdown in borrowing that was seen in some of the more traditional Asian markets such as Hong Kong and Singapore. Now, when we look at revenues by lender type, as we've already seen, asset managers, pension funds, insurance companies and sovereign wealth funds are all the most common participants within the securities lending marketplace. Now, using revenues for the first 5 months of the year, we can see that asset managers have generated the largest share of market revenues. To the end of May, asset managers generated about $1.5 billion worth of revenues from securities lending activity, which was approximately a 25% decrease than was seen during the same period of 2024. Now, this difference is down to primarily the falling specials activity that we've already mentioned earlier on in the other slide. Now, pension funds experienced a decrease of around 16%. Insurance funds experienced a fall in revenues of around 26%. Now, this reduction is mainly due to a decline that's seen in lending fees across both government and corporate bonds. Now, when looking at basis points return, that also fell across both equities and corporate bonds over the period. In the corporate bond market, average fees have been in decline pretty much since the interest rate pivot as well. An expectation of falling rates and a decline in the risk of recession has softened demand for corporate bond lending across the board. Now, equities have experienced fewer occasions of stocks being lent at exceptional rates in comparison to the same period during last year as well, and that's really both lowered revenues and the return to lendable metrics. Now, the sustained rally in equity prices that we've seen around the globe has also had a significant impact on the decline seen across the return to lendable values over the first period of this year. So the return to lendable for government bonds has experienced an increase over the first 5 months of the year, which is good news for lenders. And this is really down to higher on-loan balances when compared with the same period of 2023. So to conclude, at first glance, when looking at these figures shown in the slides, it would appear that the securities lending market has been weakening during 2024. But whilst this may be the case, as I did mention previously, it is critical, in my opinion, that both the revenues and the other metrics that are shared in these slides are viewed in a broader context of a longer time period. Now, as mentioned previously, 2024 is still producing robust returns in relation to any other year since 2006. And it's currently ranked as the 5th best performing year out of the last 18. So given that equity market volatility has remained low during the first half of the year, and the equity markets have continued to climb ever higher, really depriving borrowers of any real opportunity to implement any meaningful directional strategies, I really do believe that the second half of the year revenues are going to improve, and I believe that the first half of the year revenues have remained robust in both the context of the broader market environment and when compared to previous years in the securities lending market as well. Now I'm going to pass you on to Donia, who's going to run you through regulation and the other hot topics impacting the securities lending industry in 2024. Thank you very much.
Thank you, Matt. So yes, we're going to try to look together at what are the main topics that are being discussed in the securities lending industry nowadays. Obviously, this is not exhaustive list, but still, these are the main topics you need to have in mind. First of all, obviously, the context of central banks' rates decrease. It has had quite a big impact, obviously, in the attractivity on some asset class in the securities lending world. Also in terms of collateral, because if you remember, for those who are in the industry for quite some time, the cash collateral used to be much used, and following the rate hikes, we started to see scarcity in terms of cash collateral. So this had obviously an impact on some lenders who were actually accepting mostly cash collateral or doing cash reinvestment programs and so on. There's also the topic of the TLTRO repayment. We've seen that this subject has an impact when it comes to downgrade/upgrade transaction opportunities. The second topic to have in mind, broad topic, is the geopolitical situation, which obviously have an impact on the markets. Matt talked about it before. Obviously, there's the context of war in Ukraine and Middle East, bringing volatility, and also the elections. We've seen the outcome of the European election, and now the French one, who's going to take place this weekend, and the US coming soon. There's this big debate about the fact that we might enter in an economic Cold War. This is, I would say, another topic that we will be more than happy to discuss outside this webinar, but very interesting indeed. This situation obviously has an impact in the securities lending world, in the sense that we've been lacking volatility in the market for quite some time, and we've been seeing some movements. So it will have maybe a positive impact in terms of revenues and might also have an impact in terms of valuations of the assets of the lenders. The third topic is regulation, and I would say this is the most important one, as of today at least, because this is the one we have to face concretely every day. We've talked a lot, and we still talk a lot about capital constraints. The biggest hot topic nowadays is Basel III Endgame, and for those who don't really know what it is about, to make a long story short, is the fact that the financial institutions, they need to mobilize a high level of capital to back their transactions. The thing is that these constraints are quite high, and it has an impact on the profitability of the market participants. And more globally, but we will see it in the next slide, it has an impact on the financial sector, mostly in Europe. The T+1 topic has been very, very popular for the past few weeks / months. What we've seen is that so far so good. We were worried that the start of this new regulation would have negative impact on the lending programs, but we didn't see any big bang because the market participants were well prepared. And like what we've done with SFTR, we were ready to apply this new regulation. CSDR, on the other hand, is still a bit complicated in the sense that being part of some working groups Europe-wide, we have the feedback that the discipline is still lacking on some asset classes. And this is a hot topic to have in mind because it means that some people in some working groups are pushing to rise the penalty fees and maybe to go back to the buy-in topic that we will discuss later. The mandatory clearing of the US Treasuries. Some of you might say, why are we talking about clearing of US Treasuries in the securities lending webinar? Bear in mind that the repo market is very much linked to the securities lending market, or at least more than what we know. And so what happens on the repo market always at some point have an impact on the securities lending market. The SFTR in the US, the TC1, is something to have in mind as well because it might have impact on the European players. And last but not least, in terms of regulation, we put it in the regulation, but it's not totally correct, is the ESG topic. We've heard a lot about ESG the past few years. A lot of people were worried about the fact that securities lending might not be compatible with ESG. We tackled that, and everyone agreed that it could be compatible. But since then, no big news in the sense that more generally, when it comes to ESG, we've been seeing with our clients that the application of the rules, the constraints they have in mind is quite complicated. It does not just apply for securities lending. The fourth topic is about innovation. I will not take too much time on this, but I think there is something very important for everybody to have in mind is the concept of follow the sun, or in other terms, the fact that we are slowly moving to a concept of batch to a concept of real time. Why that? It's quite simple. It's the fact that we have a lot of regulation, a lot of reporting, now a lot of penalties if we don't settle on time and so on. And what the markets and the regulator want us to do is to become more in a logic of a real time where we settle real time, we report real time and so on. The reason is quite simple. It's the fact that the markets would be more efficient. But when we talk about follow the sun or real-time processes, we need to bear in mind that we need to have the technology to support us. The tokenization of the collateral also is something that is quite popular nowadays. To be honest, it's still theory in the sense that we have some big players who are starting and being active in that area, but we need to know what it is. We need to know that at some point we might have interest in participating, engaging in that topic, but at the moment it's not a big one so far. And repo clearing, it's again, it's not securities lending, but it's the fact that there's this trend of repo clearing in the US, where at some point there's a debate, will this come in Europe? Once we've talked about central banks, geopolitics, markets, volatility, regulation and innovation, obviously what is going on in the securities lending industry is that the revenues this year are inferior to the revenues of last year. But It's very important to have in mind what Matt just said about the fact that this is the 5th best year since I think 2006 for S&P Global Market Intelligence data. So it means that it's still a very robust and good year for the securities lending industry, and it's important to note that. Obviously, we've seen that some, and I will not repeat too much what Matt said. We've seen some asset classes less profitable than others for obvious reasons. We've seen as well region disparities, and we've also seen, for instance, we talked about the sovereign lenders, the fact that some beneficial owners were able to do even more revenues because they were able to engage in term trades and in collateral downgrade or upgrade trades. So now we talked about what is going on today in the securities lending industry. Let's see very quickly what are the hot topics going forward. So we have, I would say, 3 areas: market trends, so broadly volatility, but geopolitics and so on, the regulation and the innovation. So for the market trends, obviously the first thing to have in mind is the fact that we still have some wars going on and the election in the middle in France, which will have an impact on the Europe strategy in terms of, geopolitical approach towards these wars, but also the US election that are coming in November. So this will have clearly an important impact on the markets. The central banks' monetary moves, we've seen that we started to see a decrease in the rates. We'll see how it goes, but for sure this will have an impact on the financing trades, for instance, and on some asset classes. And there's this item which I think is worth noting, even if at the moment it's not very, I would say, impactful compared to the global securities lending industry, is the fact that we have a lot of global players who are now pushing to expand the lending activity on other regions, such as the Middle East. We've seen Saudi Arabia, but also Abu Dhabi market developments. So this is what we will have to keep in mind, because this will have an impact on the revenues for the second semester, but also for next year. In terms of regulation, obviously what we need to see in the future, going forward is the T+1 follow-up. We've seen that the T+1 for the US, Canada, and so on went well. Now, you need to keep in mind that there are a lot of discussions to apply this T+1 discipline in the UK and in Europe. So in UK, we are already talking about end of 2027. In Europe, there's a working group, an ESMA working group on this topic, and they will give their conclusions by end of this year. What we do believe is that it went well for the US and for Canada. UK is one country with one regulation, and one market, so it's not a topic. We do believe that, at least. For the Europe, we will need to be ready. The good news is that by then we will be more and more in a real-time process, and we will learn from T+1 in the US as well, CSDR, SFTR, and so on. But still, the European market will be more complicated to put in place. There will be the topic of Basel, and Basel, I think, for the beneficial owners, for the lenders, you need to keep in mind that it's a very serious topic for the borrowers. And what we see today is that the borrowers are already looking into solutions which might impact your lending program. I'll take a simple example, the fact that some lenders don't have a rating, so they cost much more in terms of capital, and it means that some borrowers would have to smart bucket the clients they might face, which means that they might choose, for instance, maybe to borrow some securities from a sovereign funds, which costs less in terms of capital compared to a UCITS fund where you don't have any rating. We might also see at some point the review of the profit splits. We've been in a very aggressive split phase, I would say, in Europe, but this might change going forward. You will also have to bear in mind the CSDR topic, not just for securities lending, but more broadly in terms of settlements, because if we review the penalties fees, but also if we come back to the idea of the buy-in, which was let's say, forgotten for quite some time, this will have an impact. So we really need to work on the borrowing side to make sure that the securities settled on time. It's not just for securities lending. Let's be clear, CSDR is not just for lending. And we've seen in the stats that a lot of settlement fails are not coming necessarily from the securities lending activity. Last but not least, again, the ESG topic. So where are we? Because today we've seen more broadly that the topic of sustainable finance, sustainable politics, it's quite hard to achieve because we have very tight deadlines. So we will see if at some point we will have some easing of this ESG approach. But for the securities lending industry, we've already applied most of, I would say, the main concepts of the ESG to our programs. We can already offer, and Remy will talk about it when we talk about CACEIS solutions, we offer a recall, automatic recall, so the clients can go and vote. They can select their collateral, for instance, they select the counterparts. So we do believe that we are already there yet, even if, of course, we can always do more. And very quickly, because I don't want to repeat myself, regarding the innovation, again, I'm sorry if I bother you with that, but it's very important to keep in mind this follow the sun concept. Why that? Because we will have a huge impact in terms of IT investments, and you will see the lender, but also mostly the borrowers, work a lot to make sure that there is a convergence of the technologies they are using, because going from a batch process to a real-time process means that all the systems, IT systems, needs to work together very well, and it's a massive change in the industry. For the other topics, we talked about the repo clearing. I will not go much further. We have also the topics of CCP and pledge topics to come back. We do believe that for the CCP and pledge topics, we definitely need to work with the clients who can be active and engage in this type of transactions. Some will never be able to do so, but honestly, we do believe that now the lenders are willing to hear about these solutions. And regarding the digital, there are a lot of let's say, I would say trendy topics about tokenization, cryptocurrencies. What we can see so far is that it's still theory, even if, as I said, we've seen some very nice initiatives in the market. What is important today for you is to understand what it is. What is tokenization of collateral? What are we talking about when we talk about cryptocurrencies applied to securities lending? So that's pretty much it for me. I think we addressed most of the topic, and sorry for those we did not address, but happy to discuss afterwards. I now give the ball to Remy, who will present our CACEIS market solutions and explain how we bring added value to our clients through our solutions.
Thank you, Donia. So now, after we've seen the industry performance and the regulation with Matt and Donia, let's review the first chapter of this webinar with the CACEIS market solutions. First of all, CACEIS is a very reputable custodian in Europe, and thanks to its position of top player in this industry, CACEIS is offering what we call market solutions to his client. So it offers to his client very good access to solutions like execution, auto FX and direct FX, currency overlay, clearing, and securities finance. The fully integrated solution, what we call the one-stop shop solution in CACEIS, is offering what we call the execution to custody. So that's a way to for our client to benefit from a process where all the operations are fully integrated front to back office, taking into consideration all the flows in the different departments, but the management from different teams, and everything remaining with a straightforward process and very efficiency and also compliance with the constraints of our clients. Now we will focus a bit more on the CACEIS Securities Finance solution. So it's a desk which is essentially based in Luxembourg, but acting on every market where the lending is possible and regulated, on every asset class like equities, bonds, corporate bonds, and sovereign bonds, but also ETFs and convertibles. This team is a team of experts with seniors, traders and sales in the industry since many years. So with a strong knowledge and on strong knowledge on all the type of clients, whatever they are, institutionals, funds, central banks, pension funds, or corporates. Now we can focus on the main services that CACEIS is offering. First of all is the securities lending. The securities lending can be offered into two different structures that could be agency or principal. In the agency model, the portfolio is lending directly to the borrowers, so CACEIS is acting as an agent. In the principal model, the portfolio is lending exclusively to CACEIS, so that's its only risk, and then CACEIS is returning the shares, the securities in the market. Both models can be implemented into a remote process that we call remote because it's, for example, for clients that are not deposited in CACEIS, but in another custodian. So it's a process that is already in place for some of our clients and that is can be duplicated. Now the second main business opportunity is the securities borrowing that can be offered into two different models. First one, the FEL coverage, where the client is borrowing on demand the securities and then decide to return the securities once he has no more needs. And also the auto-borrow. Auto-borrow is a process that has been developed when CSDR entered into force to make some more efficiency in the transactions of our clients. So it is screening the positions of our clients on a settlement date of their sales, identifying the positions that need to be covered, and sourcing some securities to the client, and the day after and all day after identifying when the client is long again to return the securities. It's a solution that is also, we talked about T+1 earlier. It's a solution that can be fully applicable to clients who want to have some more efficiency on their settlements on T+1 in North America, but also that if it comes when it comes into force in Europe. The third opportunity is the securities financing, what we call asset switch, that could be collateral upgrade, downgrade, to offer some more LCR to the banks, offering HQLA versus equities, for example. But also the securities, the financing operations could be repo, reverse repo, when our client wants to borrow some cash. So we are offering some some cash versus collateral, but it could be also clients who are regulated funds who are long cash and have to be under maximum ratio at the end of the day. CACEIS will borrow the cash and providing some good collateral to the client. So now we can go to the 5 key points of CACEIS offer. First one is the global presence of CACEIS. So we've seen that CACEIS is acting on every market from Luxembourg hub, but also on all asset classes. The risk approach is very conservative to remain in the same time competitive, but also giving the maximum security to the clients in their operations. Some tools have been developed to monitor carefully the operations and to always have some strong monitoring of the positions. The expertise of a custodian who knows the constraints and the obligations of all types of clients, like institutionals, UCITS-regulated funds, pension funds, or central banks. So it's very important to be comfortable, and CACEIS is able to offer this comfort to the client. And the proximity, which is a regular and a daily presence with our client on every topic, but also some regular reviews of and market updates to our clients who need some colors. Now that we have seen the CACEIS services, we can go to the questions. I see on the screen the questions that are arriving or have arrived before. First one, how do you explain the significant rise of sovereign entities in the lendable pools this year?
I guess that one's for me. So I would say 2 things. So we saw across the board that lendable values were up across all market participants, and that's due to a large increase in market valuations over both equities and in the fixed income space. So that explains some of the increase that we saw. But also we provide, or how we run our product is on a give to get model. So if you want to receive the data back, you have to give it to us in the first place. So the fact that there has been such a significant increase would suggest that there are more sovereign wealth funds providing their data to us, which I think is as a result of the strong market returns that have been seen over the last couple of years. There's more asset managers that want to be involved in the securities lending market.
And if I may add, because we are discussing and we have some sovereign clients, there's also the fact there's a big push from borrowers to try to get sovereign funds engaging in securities lending activity for the reasons we said about capital costs. So they've been more active as well in this area, and we've seen that with this topic of capital constraints, there will be more and more big push towards this type of clients and entities.
Okay, thank you very much. Second question, T+1. Big topic. What is your feedback since the start of it in May? Do you see more fails, struggles amongst the clients in your lending programs?
You want to
take it?
Yeah.
Well, actually, so the T+1 in North America has been well anticipated in our program. I take as an example, we have developed structures of what we call the follow the sun. So it's a process where we are able to recall at any time the positions lent to the borrowers, whatever the time in Europe. So to give you some feedback, yes, clearly we've been prepared. We've not seen more fails on the market than historically, and it's been quite smooth. The transition has been has moved smoothly, so we are happy that it went well when it moved. The standard cycle has been reduced.
I would agree, because I was expecting in the short to medium term to see a bit of a bump in the increases on on-loan balances after the move to T+1, as market participants looked for extra liquidity to be able to bridge the timing gap between what was T+2 to T+1. But looking over the data, it looks pretty flat. We haven't seen any big increases in borrowing activity, which would suggest that everybody was very well prepared, and that it's perhaps been a bit of a year 2000.
Let's not jinx it. Actually, if I may add something, because in our previous session in French, we've had an interesting questions about the fact that some people think that if T+1 arrives in Europe and in UK, this will be the end of the securities lending activity. And at least my strong belief is that it's not going to be the case at all, in the sense that never forget the fact that the financial markets needs securities lending. And we've heard this when SFTR came, because they said it will be impossible to report all the reporting you have to do will be too heavy. We did it. CSDR, even if we have a problem or we are still not where we want to be in terms of discipline, it went quite smoothly. T+1 in the US, and bear in mind that for T+1 in Europe, if it happens, we still have quite some time to adapt, and by that time we will be even better in terms of, again, real-time / follow-the-sun processes. So it's really about having this industry moving to a real-time mindset, but we need securities lending, and we've been able to adapt, we've been resilient, and the regulators, they don't want this activity to stop, because otherwise, apart from the revenues for the beneficial owners that they will lose, this will be a bigger issue for the market, financial markets integrity in general. So I really do not believe that.
No, and I agree. I mean, there's a whole raft of reasons why market participants either lend or borrow securities. To cover settlement fails is only one of those reasons. So, I mean, securities lending will live on whether we move to T+1 or T+0.
Yep.
Okay, next question. Do you believe that some lenders will not be able to face some borrowers anymore if Basel Endgame happens?
Well, I'll leave that to you.
Okay, thank you. Well, at this stage, this is not the case. But for example, we've seen some panels last week at the ISLA conference, the Association of our Industry, and it's a topic that has been discussed, that maybe some clients that could not be rated could be approached differently in terms of securities finance. If we go into this trend, maybe the rating will be a topic.
I do believe as well. It's very serious topic, in the sense that the capital requirements, they come from the top of the chain. That's what we see as a banking group, for instance. So if at some point providing securities lending / financing services will be too costly, we will have to reduce somewhere, and we will have to start somewhere. So this is a big topic, and the reason why we are advocating in terms of I would say, regulation ease, because it's going to be very complicated for some beneficial owners to continue doing lending, not maybe in 1 or 2 years, but if we think about, medium term and more widely, it will be a problem for the European competitiveness, but this is a more global topic than securities lending today. Actually, I've seen that we are running out of time. So thank you very much, Matt.
Thank you very much.
As usual, for being with us. Very useful, interesting data to share with us. Thank you, Remy. Thank you to everybody who participated to this webinar. There will be a replay on LinkedIn and on CACEIS.com website. And obviously, for those who know us, and even if for those who don't know us, do not hesitate to reach us and to continue the discussions afterwards. Have a nice day, everybody.
Thank you.
Bye.